Welcome back to Investing with Mackie. Today we're taking a look at two crucial terms in the options market, open interest and volume. At the end of the video, we will take a look at two ways this data might help you to formulate your trading strategies. As a quick note, if you want to explore any of the charts used in this video, a link is available in the description below. When you open up details about an option within your broker website or mobile app, you're presented with a lot of data. These two items can be foreign when you're starting to trade options. First, let's define volume. When you trade stocks, you can watch the volume and compare it to historical volume. Depending on what's going on in the market, you may see spikes or lulls. With options, you can observe the same thing. Option volume is updated throughout the day and tracks the number of contract transactions. If I buy a specific option at the start of the day, the volume will increase by 1. If I close that option later in the day, it will also increase by 1. You can see this increase on our chart. This page shows options from December 22nd at 9:37 a.m., 7 minutes after market open. You can see the most traded contract is the 475 strike with 33,805 contracts traded. As we look at this chart, we should note that volume is measured for each contract. This means that each strike and expiration are tracked independently. You'll notice options near the expiration and near the strike price tend to have higher volumes. Here we can see the end of the same trading day at 3:52. The 475 strike price still leads the way with a whopping 561,268 contracts traded. While I think volume is pretty straightforward and simple, open interest can take a minute to wrap your head around. Open interest is the number of open contracts at the start of the trading day, or the close of the previous day. These options have been opened but not closed. In my previous example, if I bought and sold a contract on the same day, the open interest would not be impacted. This is different than stocks. With stocks, you can generally assume the number of shares will stay the same. With options, if there is demand, sellers can keep selling more contracts as long as they have the collateral to fulfill the contract. This means that on a day-to-day basis, the number of outstanding contracts can change, which we'll see is that open interest. This data does not update throughout the day like our volume. For retail investors, you can see this data updated at the market open from the previous trading day. Here we can see near market open and near market close. While these two appear to change slightly, all that we're seeing is the colors changing. There's no change throughout the day within the data. So there's a quick overview of volume versus open interest. But what makes this so interesting is following this data over time. This page shows the summed open interest for all contracts across all strikes and expirations for each day of trading. It is further broken down by puts and calls. You may have heard of the phrase put to call ratio, which we will look at further in a minute. What I think is so cool on this chart is we can see the increase and decrease of open interest over time. For instance, we can see upward trends followed by steep drops around the monthly expirations, indicating that the monthly expirations tend to hold a lot more open interest than maybe the weekly or even the daily, which makes perfect sense. Now let's take a look at the same data, but for volume. Here we can see a lot more noise in the data. There is less well-defined trends like we saw in the open interest. It goes up and down a lot, and broken out between the two, there's not really any significant difference. But what can we do with it? We can take a look at the put to call ratios. So here we have the volume ratio at the top a price reference in the middle, comparing it to how price potentially is changing. And then on the bottom, we have our open interest. At this scale, it's hard to see any real correlations within the volume and really any minor correlations with the open interest. But what we can see is the price does tend to follow, or the open interest does tend to follow the price action much more closely than the volume. The goal, though, or the question is, can we use this ratio to predict price movement as a potential indicator? I made a video that takes a deep dive into this topic, link below in the description, and at least based on my analysis, for SPY and QQQ, I have not found a good indicator. Individual stocks may have different results though, as those traders are looking at a specific market and a specific item or company. Lastly, we can look at individual open interest strikes over time. Kind of a mouthful. But what we are looking at here is the open interest for strikes from 450 to 425 expiring on January 19th, 2024. I've plotted the price of SPY under as a reference. So if we look at the data back in January, we can see the highest level of open interest was the 460 strike at 9,000-ish open contracts, which as of today is within $15 of the current price. At that point, it was trading somewhere around 400. As we move to the end of the December, that is still the highest strike, with the second and third highest at 470 and 475 respectively. So perhaps option traders a year out, back in January 2023, had a decent idea where the price might be. With that, we've come to the end of our video. If you have enjoyed this video, make sure to drop a like and consider subscribing to Investing with Mackie for more insight into option trading. Drop your questions and topics you'd like us to explore in the comments below. As a reminder, links to the charts from this video are also in the description.